Well, warm welcome to everyone to our next webinar here. The global crisis has just begun. Where are we heading? Good to have you all here today. And hoping to share something of value with you. Make your time worthwhile. I must thank you very much for joining us. And we've done our best in terms of preparation to give you all you need tonight. So let's get stuck in. Yeah, so it's we've got you. The global crisis has just begun. Where we're heading. What we want to give you is the what, why, how, and where. And perhaps just a quick intro for those that are new to me. We've been educating clients about the how, why, and where in relation to financial markets since 2005, and helping clients to empower themselves, optimizing the exchange transactions. So at first we started on the rand versus dollar, euro, and pound. More recently, we've been looking at some of the majors, other financial markets, but we've covered a whole range during this period, the last 15 years, and that's what I want to use tonight to share with you. So perhaps just a disclaimer too. Obviously, this is provided for information purposes only and should not be taken as advice. And no past performances are a guarantee of future performance. Trading in financial markets involves risks. So don't risk any more than you are willing to lose. And then let's get on to what I will share with you today. And break that down into 4 questions, really. What actually drives financial markets, which is important to give as a setting for what we're going to share with you today. And then the how. Will this result in a recession or depression? How will this end up? Why? What are the underlying weaknesses, risks, and cracks in the system that we've seen? And then where? Our focus on currencies, stocks, cryptos, metals, etc., etc. So let's start with what actually moves financial markets. And let's start with debunking 3 facts or beliefs. The first fact is that fundamentals do not drive markets in the medium term. And what we've used here is the dollar rand as an example, but there are many examples. Here, what we have got is the producer price inflation adjusted rand. So if we take the inflation in terms of producer prices between South Africa and the US, that the exchange rate should be there to adjust for those differences over time. But what we can see here is these various lines here. If we take from 1957, we get the green line here. That's where the rand how the rand should have moved. And from 1970, when the rand was not pegged against the dollar anymore, we get this lower figure here with an average of the brown line. As you can see, over time, the rand should depreciate in line with this brown line here, but we've seen these huge swings either side of that. And if we look at the underlying reason for that, is that in forex markets, and the rand is not the only one, that actual goods and services produced only comprise about under 5% of the actual of the forex volume, the daily forex volume, the rand exchange market. So the balance is all speculative, and whether that's invested in stocks, bonds, properties, and the likes within South Africa, it's all really speculative. Of interest within South Africa, non-resident activity here is close to 60%. This is about 4 years old. Needs to be updated, but just gives you an idea. The fundamentals do not drive markets in the medium term. The second fact is that news and events do not give direction. If you had been reading our rand reviews on a weekly basis, you would have picked this up quite often. But here's a clear example, again, just from a South African perspective, because most of you are from South Africa, and obviously are from there originally. But here, back in when we had the initial junk status downgrade, that should have been negative news. What was negative news, but it should have affected the rand negatively, but we saw the rand strengthen. Again, when we had the S&P junk status downgrade, the market had already peaked and it started to drop, and we just saw the rand strengthen further. So again, there are many examples we can show you on the side that news and events do not give direction. They are merely triggers for moves. Often those big events happen at highs and lows, but they do not give direction. And then thirdly, what is important to understand is that we tend here to exchange, but we tend to enter and exit markets at the wrong time. So from here we can see the South African net investment position, which is offshore investors investing into South Africa, and South Africans investing offshore. We can see here that when the rand was weak, persons were sending money offshore. When the rand was strong, persons were investing into South Africa. Here, when the rand was weak, persons were taking their money out, when they should have been doing exactly the opposite. Should have been bringing money in at these times and taking money out at these times. So that is just the human nature, as we'll get to in a few slides' time. So I want to start with giving you a view of how we see the markets move, as to what actually moves the markets. And this is any financial market, but we'll relate it to currency markets. So whether it's dollar, euro, pound, yen, what persons normally think of this as like a seesaw, where we've got positive events and negative events. And the traditional way of looking at this is, whether it's economic, financial, political, or social, data, events, and news, that there can be some of these factors that are more negative or bigger factors, and some that are positive, more positive, or a bigger factor. And the traditional way of looking at that is the fundamental analyst. So what he does is he takes a look at these events and he says, we're having this data release coming up. If it's better than expected, well, then we can expect the seesaw here to rise, so the market to rise. If it's worse than expected, actually turns negative, then we can expect the market to fall. And that is generally how persons view the market and what moves it. But the fact of the matter is, it's not like that at all. It's not these events that move the market. It is a seesaw, but it's not the events on that seesaw, it is persons. It's actually persons that move the market based on how they are viewing these different factors and events at any one point in time. So what happens is we get that same event happening. If more persons turn positive as a result of that and take positive action, we see the market rise. If persons turn negative at that point, they take action in relation to that and the market falls. So it is what we said, it is a seesaw, but it is persons that are looking at these events based on how they are regarding those events. And some might regard these as more negative, some might regard that same event as positive. So very important to understand that it's not the events themselves, but it's those events filtered through these persons. And what is so interesting to understand is that all these events at any one point in time filtered through all these persons involved in the market, which are millions of persons in various, from individuals to hedge funds to central banks and so on, with a turnover year of $6.6 trillion a day, the Forex market. All that at any one point in time comes down to 1 point, which, depending on the exchange rate, to 4 decimal places, which is remarkable when you think of it, that you can take these probably millions of bits of information filtered through millions of persons, and what you get from that is 1 point to an accuracy of 4 decimal places. But of course, it doesn't stay there, and we see the market moving in these sort of patterns up and down as these events change and as persons take decisions based on that. But if we can ask you, what is this a reflection of? For most of us, I'd say when I started off, I always looked at this as being a reflection of these events. But clearly, it is not that. It is these events filtered through these persons give these patterns. And what causes those patterns is our decisions as to what we do. And factually, our decisions are 90% emotional. So when we make a decision to buy or sell, do something like that, or not to buy or sell, to sit out, generally that's an emotional decision. And as a result, these are patterns of emotion, patterns of mass human sentiment, and they tend to recur. So at similar points in time, we tend to do exactly the same thing do exactly the same thing over and over and over again. So Keith, you've got it there. That's our emotions. So because of that, because they recur, there is some predictability about that. And what we like to, if you've been on previous webinars, you would have seen this. It's similar to weather patterns. So if we look at weather patterns, what we see here is the 3 hurricanes heading towards the US here, or here, one in the Gulf. These are patterns, are weather patterns that are repeating themselves. And why are they predictable? It's because they're governed by the laws of nature. And the laws of nature don't change. And so these patterns recur repeatedly in smaller and larger degrees over time. And as we've seen with these weather apps and so on, the more analysis has been done in understanding those patterns and the laws that govern them, the better we can forecast future patterns. Now, with humans, patterns of human emotion also repeat themselves. And why is that? It's because they are created by emotionally charged actions of human beings who are governed by the laws of human nature. So what we are is governed by the laws of human nature. We tend to do things in the same way, and these patterns recur repeatedly in smaller and larger degrees over time. And so similarly, the more analysis has been done in understanding those patterns and the laws governing them, the better we can forecast future patterns. So how do financial markets move? And why do we tend to reach extremes? Well, as in any cycles in nature, we get ebb and tide, we get growth and decay, summer and winter, waxing and waning, and so on. In markets, we get those similar patterns where we get a trend of 5 waves going up, and then we get a counter trend, and the trend resumes. And the counter trend, generally a 3-wave pattern that partly retraces the 5-wave move up, and then the trend recommences. And this happens in smaller and larger degrees. So each of these waves will be made up of 5 waves, 3, 5, 3, 5. So if we look at this in terms of our seesaw, where we are at a low, the market is coming here into a low. At this point, everyone has turned negative. So there is no one left here to turn negative and take action to push the market lower. And so the next person to take action is a positive movement. And slowly that will happen as the market pushes up, more persons will start to turn positive. Until we get to a point halfway through here where persons are neutral. Half have turned positive, half are still negative. And then as we head up into the last wave, we get to the peak where everyone has turned positive. and there's no one left to turn positive. And so we reach an extreme where everyone is positive, to the degree of euphoria. And what we find at those points is the market turns, and the first a person that turns, the first action that is done is someone then turning negative. And so the market heads down from there back to our low again. Trust this is making sense, but please see it on the chat there. Janine, flow and adjust to the times of now and change mindset to so business. Yeah, if persons just are not understanding, please just ask questions here. But just to give persons another idea of how we look at this is what actually drives financial markets. So our actual emotions is we've got a fear and greed meter. If you look at the mass sentiment, where we are at any market low is a point of extreme panic, or as we'd like to say, actually despair at this point. And then once the market moves up, that lessens off until we get to halfway through this move, where the market turns neutral. And then we get to the point where the market has pushed right up, and we get to the point of extreme greed, or as we said, euphoria. And then the market falls and fear starts coming in again. Market picks up and persons get less fearful, and then the market drops right down to a new low, and we're back to despair again. So those are the emotions that we feel at these various points in any market. And these can be at different degrees. You know, we can be more fearful than we were last week, but you know, take the dollar rand, we're not as fearful as we were a couple of weeks back when the market hit its high. So, but we can be more confident than we were yesterday. So there are different degrees, and that's what is important to understand, is where we are in the longer term picture in terms of these patterns. So I think if you haven't picked it up by now, the hidden enemies are emotions, because at these peaks, we ourselves are emotionally, so for instance here, the dollar rand, at these extremes, we get exporters and so on that are greedy or complacent. Oh, well, the market can only go higher, so we'll just sit out, while importers and SA investors are panicking. And everyone you talk to is saying the same thing. Well, the rand can only go higher. But that is the point at which we should be taking exactly the opposite view, is we should be taking action the opposite to what our emotions are telling us. So as Warren Buffett has said, be fearful when others are greedy, and greedy when others are fearful, which is not an easy thing to do, but it's imperative to understand that your emotions will always tell you to do the wrong thing every time. Doug, graphs, what time scale is it? Weeks, months, or years? If you're talking about the graphs that I was speaking about here in terms of the patterns, I mean, we could actually show you it's from minute graphs to hourly to daily to weekly to monthly. So every these patterns appear in every time frame. Okay, Claudel, thanks very much for your feedback there. So just to summarize, then with the paradox, which it's important to understand with what we're going into now, I'll show you in relation to where we are, is that the market is a reflection of human emotion, mass human emotion, which tends to drive the market from one extreme to the other. And these create repeating patterns, which are therefore to some degree predictable. These emotions will more often than not result in us making the wrong decision and taking the wrong actions, especially at the extremes. And this happens time and time again. So unfortunately, as humans, we don't tend to learn from history because it's what we are. So as our human nature does not change. And then the more people who feel the same way as us, the more likely we will be making the wrong decision. So if we go back to our seesaw analogy there, everyone's on the one side of the fence. Everyone you're speaking to is feeling the same way. Well, then we'll likely be making the wrong decision. So how do we, what's the solution to this? What we need to do is eliminate our emotions in the decision-making process through having an objective view of where the market's expected to go and an objective system as to when the optimum time to enter or exit that market. So I'll put your exchange, but enter or exit the market. And what this does is enable to make an objective, informed, and educated decision, and then take action at the right time. So I think there are a lot of comments coming through there. Desiree said, unfortunately, those who know how to play on people's emotions, instilling fear. That is true, but there is a side of just cycles of social mood itself, where those cycles tend to go from positivity to negativity. So it can be in a period where there is that change that are more susceptible to those negative thoughts. But is there any, well, Sean, good time to hold on to dollars or better to convert to rands? We'll get to those decisions. But is there any, are there any questions in relation to what we have covered so far? Well, William said, never bet against the trend. Yes, while the trend is in play. So the trend is your friend, but once it's got to an extreme, you need to realize when the trend is about to change and has changed. So Craig, where we are in the scale, that's exactly what we're going to get into right now. Thanks, Terence. So let's jump into the current crisis. And really, there's been a lot of talk about this. Are we heading into a recession, or are we heading into a depression? And this is obviously very important because it affects all of us. I don't think there's anyone on this webinar that's been through the past depression, 1929 to 32, 33. But we've been through recessions, and we've been through some severe ones, the last one being 2008. So the question is this 2008 again, or is it something worse? Well, I think to start off with, we need to understand the difference between a recession and a depression. And if I put my own analogy to it, a recession is like a forest fire in nature's normal cycle. So we have a forest fire where there's been undergrowth that is built up and so on. What it does is that it's destroyed, but what comes out of that is new life and into a positive cycle again. New life, new growth, and so on. So what it's marked by is a period of economic contraction in a normal business cycle. And it is triggered by a deficiency of demand for goods and services. And this results in falling prices, which in turn result in a decline of total production. And what that generally lasts for several quarters, a recession. A depression is more like a devastatingly destructive forest fire, where it's not just undergrowth, but large parts of the forests are actually also destroyed. Effectively, this is a prolonged period of economic contraction after a period of prolonged prosperity, and a decline in prices and total production which lasts several years. And then what we need to understand is inflation versus deflation, because what we tend to get in times of an economic boom is inflation, and what we tend to get in the times of recession and more so depression is deflation. So inflation is an increase in the volume of money and credit relative to available goods, and the result of this is the prices of goods will generally rise. While deflation is a decrease in the volume of money and credit relative to available goods, and the result of that is price of goods generally fall. So they say, Craig, artificial prosperity. Well, what we normally find in those, you can say that fifth wave is it is artificial. And we'll cover that in the coming slides. So what's important to understand is what causes a depression. And as you know, what we use ourselves is the Elliott wave principle, which was discovered by Ralph Elliott in the 1930s. But his contemporary Hamilton Bolton in the mid-90s did studied depression since 1830s, and what he concluded after this was that all depressions were set off by a deflation of excess credit. So there'd been a buildup of excess credit, and the depression was set off by the deflation of that credit. And so sometimes this excess of credit situation seemed to last years before the bubble broke. Some outside events, such as a major failure, brought the thing to a head, but the signs were visible many months, and in some cases, years in advance. So on the right-hand side here, a well-known depression was Japan, where we had the boom in the 1980s, Japan's economy, going up to the late 90s, 1989, I think we had stock market top. But what accompanied that was this huge buildup in debt over those 10 years. And we saw a stock market top and stock market crashed. And what followed that was the economy contracting. And because of that, GDP contracted, but debt hadn't contracted yet. So we saw the debt as a percentage of GDP push up here over the next few years before collapsing. So this was here, the deflation of this excess credit here occurred for the next, almost 15 years. And Japan's still battling to come out of that. So this gives a good example of what Hamilton Bolton concluded from his study. If we look at the US, and this is not limited to the US, but what's important to do, I think, is to focus here in the US because so the data is more readily available, but also what happens here will affect the rest of the world. I've got just a question here. I don't understand the point that depression is set off by deflation of excess credit. Can you explain that? Well, what is there was a precursor to a depression coming. So let's just have a look at this with the US itself back in the 1920s. Again, we had a huge buildup in credit. So persons were prepared to take on credit, whether it was household-wise, corporate-wise, municipal-wise, government-wise, private and public sector-wise. Huge amounts of credit. So what we saw here around the time of the Great Depression is that reached a peak where the total debt in the US as a percentage of GDP reached a peak of 264%. So effectively that meant the US would have to work for 2 years just to pay off its debt if it did nothing else with it. And here we can see what happened is something triggered a change here in mood in terms of wanting to give out credit and wanting to spend more money. And we saw this peak and then eventually drop right down here over the next 20 years or so, where we saw this debt, deflation of debt, which was accompanied by the depression. But since then, what we see is we've had this increase here up until about 2008. We saw this peak, which, as you can see, is far higher than what we saw back in 1929. We've reached a peak 2008 or so, 378%, but we are still sitting with a huge debt problem here, 352% at the moment. $75 trillion. So that's the US. But if you look at global debt, this has continued to swell since 2008. So whether it's household, whether it's non-financial corporate or government, we have now continued to take on more and more credit. And the fact of the matter is, someday, some way, that credit needs to be paid off. But it's in a worse situation than we were in 2008. Of interest, that what happened over this period, 2007 to 2009, is private debt has pretty much stayed constant as a percentage of GDP, but public debt has increased quite dramatically. So what overall, we're sitting in a worse debt situation, and then we've got governments throwing extra debt at that to try and solve a debt problem, which is not going to solve the problem. Peter, who does the world owe all the money to? That is a good question. It's you can say to one another. I mean, you can have you might have bought government bonds, or you might have bought a property and mortgage on that's owed, or you could have taken a loan from some bank and so on. So it's a whole debt situation where you might have taken on debt on one side, but on the other side you've got assets that you have purchased or investments. But you think of it like the stock market, where you invest those in stocks. But if the market falls 30% and you've taken out a loan against that, your ability to pay that back is just gone because the stock market has dropped. So that what happened over this period of time in 1929 to 1932 is there was either the paying off of debt if persons were able to, or restructuring, which just extended the period. But a lot of it was actually just written off because persons went out of business. Many bankruptcies. So it's as you can see, it's a global problem. Worse here in some places than others. North America and Europe, Australasia, but then also be sitting with China and Japan and so on. These areas. South Africa, not as bad as it was in terms of global household debt, has reduced, but still a problem. But just an interesting one that we looked in the US. As I say, it's easier to get this data, but from 2008, we can see we had a problem here of debt. We got a much larger problem. Yeah, student loans back here were about $700 billion. That has now increased to from 700 to 1640. So we are sitting with a far bigger debt problem than we were in 2008. And again, here, government expenditure, US government expenditure versus tax receipts. Since this period here, 2008, we can see that government expenditure versus tax receipts, we've got this huge hole here, which has needed to be funded. So this has just been increasing total debt. So a far bigger problem than we are sitting with in 2008. And a far bigger problem means a far bigger correction once the bubble pops. So there we've had a look at, let's say, the cause, underlying cause was an excess of credit. We can see how there's a huge excess of credit. But let's look at another couple of indicators as to where we are compared with 2008, when where we are compared with back in 1929. And this is an important one, is velocity of money. What is velocity of money? Well, if you look at the bottom here, what we get here is money supply, which is supply, the amount of money, you say, in cash and checking accounts, savings accounts, etc., 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 multiplied by the velocity of money equals your GDP. And the velocity of money is how many times that $1 is spent or changes hands to buy goods or services within that period. So if Craig, I lend you a dollar, I pay you a dollar for a book or something, and then you take that dollar and you go and spend it on some fish and chips or something, and then from Sean, and Sean takes that and he goes and spends that on something else, well then that's a factor of 3 because it's changed hands 3 times. And it's that velocity of money that actually is what we see in times of proper booms. We can see the velocity of money increase. So if we look back here in 1918, we actually got to a peak, and then the roaring 20s that actually decreased to a point here in 1929 where there was less, persons were spending money less. And then during the Depression, that even dropped even further down to these levels. Now, where we were in 2008 is we had reached a peak, 1997 up here, 2007, 2008, there had been some decreasing velocity. Persons not generally willing to spend money. On the government side, you can see that Fed, since that time, has been increasing this money supply from 2000, 3.5 times increase in money supply from this period to date. But despite them, it's making more money available, making more credit available to persons to go out and spend the money and to generate something in the economy, what we're seeing is persons are less and less and less inclined to spend and pass that money around and buy goods and services with it. And based on where we are at the moment with this current crisis with the COVID-19, that is likely to continue. So what we are sitting with here is we are in a worse situation than where we were in 1929, and a far worse situation than we were in 2008. So the outlook is not good, because in terms of getting the economy back up and running again, and here we have Trump saying there's pent-up demand. Is there actually pent-up demand when the economy has already slowed down with huge lockdowns globally? So not a good sign. One thing that was interesting is it seemed that everything started, once the coronavirus spread. But what we were looking at if you were looking at the news back in September, October, November, December, that there were stresses in the interbank lending market globally, and especially here in the US, where the Fed had to step in to provide liquidity. And that was because banks were not prepared to lend money to each other, worrying about the ability to repay. So the Fed had to step in. And so these were cracks what these were showing is that there'd been a change. So this whole period here where there'd been minimal activity, suddenly we jumped into this period here, the last bit of 2019 in 2020, where there'd been a change of attitude with banks. So a change of mood in terms of willingness to extend credit. So there were some initial cracks in the system already. Yeah, and just see a sound gone here too. Can everyone hear me? Just can we just have a yes, those that can? Okay, good. Thank you. Okay, very good. Okay, just an example is the stimulus package. We look at what was done in 2008, 2009 versus so far this year. As we can see, 2008, 2009, 787 billion. So far, 2 trillion. So clearly, the problem is far bigger than we had in 2008, 2009, and government is realizing it. So just another indicator, it's a far bigger problem than 2008. And then employment. If you've been looking at the figures, US figures here, quite staggering that initial jobless claims for unemployment the last 3 weeks totaled 16,780,000, with the peak here at 6.8 million in 1 week. Back in 2009, which was the peak in terms of claims, we are sitting with 665,000. Now, the fact is, yes, it has been artificially perhaps created due to government intervention for closing down business and so on. But nevertheless, these are the numbers. And what the next few weeks will show is that actually that quite a lot of persons haven't had the ability yet to claim that. So we expect in the next few weeks still to be some fair-sized numbers. But what that means, if it is just a week or so of similar numbers, is that the last 10 years of improvement of employment has been lost. So 2008, we saw this adjustment in terms of employment. Already, we've seen 17 million off here. So again, the problem is far, far bigger. And then we're talking about sentiment extremes. Then when sentiment reaches an extreme, expect the market to reverse. Just two interesting studies here in Google Trends. Interest over time, how to buy stocks in 2008, how to buy stocks early 2020. Buy the dip back here in 2008, buy the dip in early 2020. So as we can see, it's a sentiment that reached an extreme of euphoria. And we don't perhaps need to show you, anyone's looked at Trump's Twitter account, every new high in December and January, I think he had a tweet going about new highs. I don't think we've seen anything the past couple of months on that. But it's just giving an indication that we had reached a sentiment in terms of extremes and euphoria about where the market is going. So we had news headlines, the Dow will reach 30,000, 35,000, 40,000, 50,000, so on. And of course, we know where we are now. But what is necessary is actually to tell us what the patterns of sentiment themselves are telling us. So we've given you some indications here that actually the problem is far, far bigger in terms of debt that is built up, in terms of the indicators of showing where, so the cracks in the system. But what are the patterns of sentiment telling us? Well, just like to show you what we did, analysis we did do back 4 years ago, 3.5 years ago. Here's a forecast on the S&P 500, where we had looked like we had a third wave, fourth wave, and we're into the fifth wave, and the fifth wave of that fifth wave, which was we expected to head up into this area. Now, what did happen is we had the market extending a bit to just above that area a little bit, but in price and time it did extend further. But since then we've had the significant drop that we've had. On the South African side, similarly, we were expecting here a move up into this area before the market dropping significantly. So that's what we're looking at in terms of larger patterns here of 1, 2, 3, 4, 5, and then within that 1, 2, 3, 4, 5. I haven't got the insert here, which I could have put in, but we'll get onto an update of this in a few slides. So that's what we were expecting 3.5 years ago for our next few years. But let's see where we are now. And I think an important thing to do to start off with is US stocks, because if you look at stock markets, they give probably the best indicator or mirror of where sentiment is, mass sentiment. So here we've got the Dow Jones index from the early 1900s. And we can see here a push up here, the roaring 20s over here to where the market peaked in 1929. And then we saw this crash of 89% in terms of stocks happening back there. And in terms of where the market was, that was a fourth wave. And since then, we've been in a multi-decade 5-wave move up, which if you count here is these red ones, 1, 2, 3, 4, and from this low here, 1970s, a push up 1, 2, 3, fourth wave in 2007 to 2008 here, and since then we've been pushing up in a fifth wave from that period. And what it looks like here is we've either completed this or very close to completing this 5-wave pattern. And that would complete this move, which would complete this move, which possibly complete a 5-wave move going way, way, way back further. Now, in terms of Elliott wave, if you look at targets, generally initial target here, if it were just this move up here, we'd see a correction down to the fourth wave of the prior degree here. So if that does happen, we're expecting a 72% stock market crash, of which we've seen 38 already, but we're expecting to head down there. But if this is a 5-wave move up from the low after the Great Depression, sorry, let's just take one step back further. If this is a move of this move up here, then we're expecting a correction down to this fourth wave here, which would be 98%. But if it's a reduction, a correction of this longer term period, then we're coming down to 99.89% or something like that. So these are the potentials. This is the minimum that we're going to be getting down to. This is more likely. And really, at that point, there's not too much difference between this and this. So the fact of the matter is, we're on the cusp of a devastating collapse. Ian, you say your prediction could not possibly be accounted for the COVID black swan event. Well, as you see, if you go back to, it's a very good thing that you put there, because as that Hamilton Bolton said, that crash is always caused by some event. We can never say what that event will be, but what we can forecast here is that this is social mood, and what we find at extremes is something extreme happens, which triggers that move. So you can never tell what it will be, but the likelihood of that happening is there in the patterns. So that extreme things happen at extreme points within human history. So you can never say what event is going to happen, but if you can look at that, the underlying problems were there, and here the patterns are telling us that a change in social mood was coming, and often that is triggered by an event. So as you say, Craig, COVID is the pin that popped the bubble. Exactly. We don't know what it would be, but it's COVID-19. And it might not be something that might not even be financial, but it will result in a financial crash. So this is a very important picture to understand as to what's coming. And if we look at the short-term picture, Ian, we've got here the Dow is up 25 in less than a month. Yes, that has happened. So we got two potential in terms of a wave count here. Either the market has topped as of 19th of February, and if that is so, I think we've pushed above 50% so far in terms of retracement. That is, in terms of a correction, we have got to a point where the market is primed for its next leg down. But there is the potential, if we do push higher and don't break below those these lows here that we've seen in March, then we could be heading into a final fifth wave higher, in which case this would have been a correction here down to wave 4 and then a wave 5 up. But if you look at all the so the underlying problems and in terms of actual fear of sentiment, there was no, we can't say that there was absolute despair here and thorough disgust with stocks at this point. I think we had reached a point of fear, but now they just turned back to hope again. And based on that, I think what we need to see is a point where everyone is thoroughly disgusted with stocks. And I don't think we've seen that yet. And based on that, we are saying that it's likely topped, but chance of outside chance of a final fling higher. So if we look at it in terms of 1929, we are most likely here. Possibly arrow should be closer to the top of this correction. Yeah, as you can see, we had a drop down and then the market retraced, I think just over 50% or so. And from there, then the market just collapsed over the next couple of years. But the alternative is we've actually had this drop and now we're on our last move up before the bubble finally pops. So, that's a view in terms of US stocks, but I think it pretty much covers global stocks as well. From a JSE point of view, here's an update of the all share index. As you can see, the market actually topped in 2018, and since then we've had a move down, move up, and then we had the collapse together with global stocks and a push up from there. Overall, it still looks like we have downside risk on that. If we are going to head higher with the final wave higher, we need to break above this 53, 44, 80 level. So we could test a bit higher in the next week or so, but the chances again of more on the downside than on the up on the JSE all share. Gary, so cash could be king. That's actually that's actually a very important question you asked there. Factually, if every market is going down, which I think we will cover, that yes, if you look back at the Great Depression, cash was king. Toilet rolls, that is, if you can find toilet paper to hoard here, but I don't think that's a good long-term investment. But let's get on to currencies and our forecasts on that. Some of you know we do cover some global markets. It's a dollar index, the euro, gold, and Bitcoin. And this is due for an update tomorrow on our Dynamic Forex Solutions global site. So I'm just giving you what the picture was last month of this. for those of you who stick around, we have got an offer that will be coming at the end of this. So stick around for that. On the dollar index, if you look at the long-term picture, we saw a 5-wave move down here from the 2001 high, and since then a correction up here. As long as we don't break above that 103.82, we are expecting the market to fall over the coming years, actually fall quite dramatically. A push up above here would not really invalidate this until we actually break above this level here. But I mean, this could extend the correction up. But ultimately, what we're looking at is the dollar losing value significantly over the coming years. On the flip side of that, we've got the euro, which is pretty much a mirror image, where we've had a 5-wave move up here with a correction, and markets moved up in a wave one in a correction which has or was close to ending, and expecting the market to push up here to the 139 to 152, but possibly higher than that as well. So, I mean, we've got those two currencies. I know there are others. We'd happily look at some others in terms of one-off forecasts for persons if they're wanting them specifically. But to just look at the rand itself, this is from our forecast a couple of weeks back, where we're expecting the market to push a bit higher before topping out here and then dropping. We went a bit beyond this idealized target area, but then dropped straight back into it and below. So effectively, we're still looking at that being validated, and a move down to probably this 1650 level at least, with these levels here, 1569 and 1517, being key as to whether this is just going to be a correction and we're now pushing higher, or whether we're going to have a larger scale correction over the coming months and possibly longer before the market pushes higher again. One thing that is interest, fundamentals need to play some part. Yes, and so they do. And as we've had, over the longer term, those fundamentals must mean that the rand must appreciate somewhere around about 6% to remain competitive. But as we've seen, there are these large swings that aren't governed by fundamentals. And something of interest too, that junk status, we finally need junk status. Surely that will see the rand weakening. Well, take some examples from Russia hitting final junk status. It's strengthened 32% in the next few months. And Brazil, when they were finally downgraded to junk by Moody's, the Brazilian real strengthened 25% in the next 12 months. So effectively, we need to look at the patterns, not at fundamentals, not at news, not at credit ratings, but at what the patterns themselves will tell us. Moving on to precious metals. I just updated the chart from our global market outlook. Because today we've just pushed above this level of the 1703.60, but we have two possible scenarios playing out here. The one, which is still our preferred one, is that this was a 5-wave move down from a high here, which we are having a corrective move off this 5-wave move down, which has extended. But as long as we don't break above this 1920, we're expecting the market to collapse. Now, I might say that seems unlikely for it to do that. There is, because we have got this alternative that the market has started a bull market from this point here, which should be 1, 2, and now we're into the third leg up. The one thing to look at is of interest. Gold lost 45% during the 1974 recession and lost 34% during the 2008 financial crisis. So yeah, we had this huge reduction before the market pushed up again. In terms of, gold and silver and so on are obviously regarded as true money, true wealth, for wealth preservation. And I'd agree with that. But that's not saying we won't see those markets down at lower levels first. And one thing we need to have a look at here, which would sort of be interesting, is to look at silver. As we can see here, that where gold has pushed higher here from this low, silver has tracked sideways and in fact has dropped to new lows this year. To lows last seen during the financial crisis. And just based on the patterns, it would seem that we could well test lower below into single digits. But two, that we see a divergence between silver and gold in terms of this area here, which is usually non-confirming of a new gold bull market. So we're not saying that this is going to happen, but just these are what the things we kind of look at, but obviously we need to look at actual levels here to confirm whether we actually in a bull market, a new bull market, or whether we will head lower. Landine, important question of yours there. What did gold do in 1929? I should have actually pulled up some data of that, but looking back at it, gold then, so that the dollar was on the gold standard, which is very different from now where we're sitting with fiat currencies. And gold, the gold price did rise then based on that person's rather having that than the dollars. And it got to a point where President in his wisdom made it unlawful to hold gold and had to sell gold back at a fixed price. So it's a bit of a difficult one, in a different circumstances to back then. But what we've seen after any significant sell-off is gold pushing to new highs. And silver here is a significant sell-off and then returning and pushing to new highs. And that is the long-term picture for both silver and gold. But we could see some decent retracement before then. Diane, what is non-confirming? It's just that they are not rising together. So gold is rising, whereas silver is falling. And a new bull market in precious metals, you would want to see both of those doing the same thing. So yes, Craig, as you say, dollar is a fiat currency based on faith, not a commodity. So back then it was fixed to gold. Each dollar issued, there had to be that amount of gold backing it. Whereas the currency now, fiat currency, is based on the faith in the government to pay it back. So that's where we're heading to, is I think a change in the whole fiat system once, if we're heading to depression now, whether it's a little bit later. I think one of the things that will come out of that is fiat coming to an end as we know it, and probably central banking coming to an end as we know it. And with that, we come on to cryptocurrencies, which it started with Bitcoin. An interesting one, cryptocurrency, because it's a similar sort of thing. It's where does it have its value? Well, it's a medium of exchange. If you compare it to gold, whereas gold is physical, this is digital, but it's also what value persons store on it. So it is a medium of exchange, and I think will become more so. And as you can see, governments are moving more and more towards the thought of having a cryptocurrency rather than fiat currency. And one big factor here is that if you hold Bitcoin, that is what it is. It's not backed by debt, which if you look at every dollar that you got is backed by a massive amount of debt that the US government has, and every government using fiat currency. But in terms of looking at Bitcoin itself, what we've seen here from when it was instituted was a 5-wave move up here, and it looks like we're in a fifth wave, 5 waves up, or possibly this could extend into a fourth wave. It could be an extended fourth wave before we see a move up. But our outlook for cryptocurrencies is overall bullish. The chance that we could see lower first. And which should take that market up to significant new highs before we have a completion of this 5-wave move up and a significant decline before the market. We have the next bull market in terms of cryptos. Some other markets that are of interest, bond markets. Just had a look at these. As you can see, we got to US bond markets back in 1929, 1920s to 1940s. We can see a decline here during the Great Depression with a bit of a spike. But we've been on a long-term decline since the 1980s and to new lows, lower lows than we saw in the 1930s, which is very interesting. But what this will, if you look at Japan, we had extended periods of negative interest rates, which could extend. But of course, when they do turn, as we see on South African side here, we had extended period of declining and now starting to push up. That's when the market that's when governments get into trouble, because their interest payments on the debt makes us a bigger and bigger and bigger problem. So for South Africa, this is going to be a problem with now being fully downgraded to junk, that these interest rates will rise on bonds, which will make repayments that's much more a painful exercise to repay. Some had been asking about real estate. Well, here we can see, again, it's not just, it's a global problem. If you look on the right-hand side, that since 2008, since the sell-off here, the market has risen globally, generally. House prices here, US house prices, to new highs. And what is seen in a depression, is depending on the area and the sector and so on, is a decline, a significant decline in house prices. Obviously, it depends, it's again, what sector and what area, but overall, you should be expecting a significant drop in real estate pricing. And one thing of interest of that is commercial real estate. I think this COVID-19 has changed how persons are going to be doing business from now on. With so many persons working at home, I think some of these larger corporates with huge offices are suddenly realizing we can actually do this without these huge complexes. Well, let's downsize and reduce the number of employees we need at head office or our different offices to 10% of that. So I see in commercial real estate, there been a glut of it, and as a result, falling prices. But I don't think it's going to be limited to that. We're going to see house prices drop as well. And you're saying there's a housing shortage in SA. This should push long-term prices up. Well, the fact of the matter, in a depression, everything drops. So the fact of the matter is, we've had, house prices pushing up, a whole credit build up, not only in relation to housing, but everything else. And there needs to be some deflating of that to a larger or greater degree. So that's about it. We'll go on to a bit of Q&A now. I see there's still a lot of questions that we've haven't taken yet. But just while we do so, I just want to thank you all for those that have stuck around until the end here, and to give you an offer, discounted promotion to our forecast, our global forecast on the one side, dynamic forex solutions, where we cover the dollar index, euro, gold, and Bitcoin, and possibly looking to add to that. And this is kind of feedback we would like, is what other markets, global markets, you would like us to cover in that. And then, of course, our long-standing Rand forecasts. We offer a free trial here on the Rand versus the dollar, euro, and pound. And that's a 14-day free trial, no obligations, just to try it out. Our global forecast, we're giving you 25% off and more if you take it for a year. So we will come back to that. Before we get on to Q&A, one question that I wanted to ask is, we've been thinking about in putting all this information together, that if you found it of value, would you be interested in us publishing a monthly newsletter where we cover these various markets and do various updates and our views and analysis on them? Yes, Skulk, there will be a recording of the video for those that of the webinar, which we will send out in the next day or so. But getting back to the monthly newsletter, would that be of interest? And what, if so, what would you like covered in that? I think is to have this as a low-priced, affordable pricing in terms of a subscription, but to tailor it based on what clients would be interested in. So I think the next few months and years are going to be quite something interesting, perhaps use a euphemism. But I think it might be useful to have something like that, but I'd just be interested in what sort of demand there would be if we did do that. So if you could just give us a yes, but also I think Alex can put up a poll there as to what I think he has as to what you would be interested in. Just as far as the newsletter itself, you could just put in the chat as to what would be what you'd like to see covered. And then just remember our discount promo again that you can get on our forecast on global markets as well as the Rand. Please take advantage of it. We'd love to share our views going forward with you. And a big thank you again for joining us. It's been our pleasure, and trust you've received the value and answers that you've been looking for. With that, we'll be over and out. Goodbye. Stay safe, everyone.